Hello and welcome to the FCC Economic Outlook. My name is JP Gervais. I'm the Vice President and Chief Economist at FCC. Welcome to those of you that are watching this event live on September 18. If you're watching a recording of this, well, thanks for joining us as well. In a moment, I'll have the pleasure of introducing my colleague, but I would like to begin with a land acknowledgement. We're meeting today virtually, and wherever we find ourselves in Canada, we are on traditional Indigenous territories and with rich traditions, stories, and histories that should be understood and honored. It is our commitment in a spirit of reconciliation and collaboration to honor Indigenous peoples as vital contributors to our society and respect the diversity and strength of all Indigenous people across the country. Now, really happy to be doing this webinar. It feels like not so long ago that we did a similar event. It was the early 2025, it was in January 2025 when we did a similar webinar. And even, we're in September, the year's not over, and it feels like an eternity. Really, like so much has happened over the course of 9 months, really, that we thought that even if we were trying to provide as many weekly updates as we can on our fcc.ca/economics website, and I encourage you to go and see what kind of the different updates that we provide with regards to different sectors and so forth, we felt like there was a good time here to pause and think about the rest of the year, so for the end of 2025, as well as giving a sneak peek of what we can expect for 2026. As I said, lots going on. I'll have a colleague of mine joining us in just a little bit. We're going to do our best to save some time at the end for Q&A. So there is on the screen, somewhere up on your screen, a question box where you can drop your question. So if there's anything that comes to mind as we're talking and as we're presenting a little bit of the different trends and variables to monitor for the rest of the year, if something comes up in your mind, then just be sure to put it in the box. And time permits, we'll address these questions. And if we don't have time, because our commitment is to be done within 60 minutes, then we'll find some other way to address these questions. So I'll start off by providing a broad economic overview. Obviously, yesterday, the Bank of Canada did something really meaningful. It dropped its overnight rate by 25 basis points. And so we're going to be talking about interest rates. But before we provide some of the most relevant information about interest rates, just like to provide a little bit of a broad overview of the economy. Now, there is no doubt whatsoever that the trade tensions with the United States is to some extent the ones that we have with China as well, and then we'll get back to that later in the time that we have together. No doubt that the tensions with the United States are having a real impact on the Canadian economy. Now, a number that's mentioned a number of times in the media is 90%, right? 90% of what we export to the US, roughly, is exempt of any tariffs. And that's true. Now it roughly evolves around 90%. If you look at ag exports, the percentage of our exports going to the US that is exempt of tariff because they're compliant with CUSMA, the Canadian-US-Mexico Free Trade Agreement. Well, 99% plus of these exports are exempt of any tariff. And if you look at food, it's around 97%-ish. So really, for the most part, exports of ag and food and overall are exempt of any tariffs. But there's a lot of confusion with regards to tariffs, even on the US side. We've got lots of customers that are telling us that their sales are being taxed and that they actually shouldn't be because they are compliant, that they've gone through the process of proving their compliance with CUSMA. Second of all, there's also uncertainty with regards to what is going to happen in the future. And with uncertainty comes kind of a little reluctance on the part of businesses to invest in their business, just waiting to see how policy is going to evolve on the US side. And finally, we do have a significant chunk of our exports, if you think of lumber, steel, aluminum, that are taxed, going to the US. And so all of that does have an impact on the economy. And then we got the Q2, so the second quarter GDP estimate, and it came negative. So we're going to bring up a chart up on the screen that looks at economic growth, GDP growth in Canada for all the way up down to 2017 to 2026. Our forecast for 2025 is a little bit below the Bank of Canada forecast of 1.3%. Our 26, we're roughly in line with the Bank of Canada and their estimate. But the bottom line is that we're very, very likely, unless we get a major surprise for the Q3 and Q4 of 2025, very likely to be under 2%, sub 2% growth for a third consecutive year, and likely a fourth consecutive year. So it's undeniable that tariffs have an impact on the Canadian economy. But there are some underlying issues as well in the Canadian economy. It cannot, the subpar, sub 2% growth, if you think of 2% as the potential of the economy, we're really going under the speed limit. And really the idea is how can we boost the economic growth with either policy or in monetary policy or government policy or any types of policies with regards to investment, consumption spending, and so forth to actually boost economic growth in the country. Now, the Building Canada Act is a great first step. We're talking about more infrastructure. And if you're thinking about, investment in ports, rail, roads, all of these can actually have some significant positive spillovers in the rest of the economy, making it easier for businesses to do business and to invest and sell and develop markets and so forth. So all of that would be a major step in the right direction. Even defense spending, to some extent, is a positive, can have a positive spillover, but that's going to take some time, right? I mean, it's not something that will materialize tomorrow. So in the meantime, faced with economic growth that is subpar or sub 2%, then the burden of rekindling, if we wish to say, the speed of the Canadian economy, then it falls on the responsibility of the Bank of Canada. And yesterday, they cut their overnight rate by 25 basis points. So that leads us to what kind of a outlook should we expect when it comes to interest rates? So we're going to bring on the screen my colleague Des Sobel, who's our Deputy Chief Economist at FCC. And Des, I'm going to go right to it. I'm going to put you on the spot. One Bank of Canada cut yesterday, 25 basis points. We got two more decisions coming up, one in October, one in December. What are your expectations till the end of the year?
Okay, thanks, JP, and thanks to everyone that's joining us today. Right to cut to the chase, we're forecasting that there'll be two more rate cuts this year. So the Bank of Canada is going to cut rates another 50 basis points by the end of the year. And as you mentioned, this is really in response to a slowing economy. The Bank of Canada doesn't want a recession to happen, the dreaded R word, but we see the economy and how poorly it's performing. You mentioned the kind of the speed limit. We're well below that, so there is a lot of room for the Bank of Canada to act. And as well, when we look at inflation is now subdued. It's within the Bank of Canada's range, and more importantly, the more preferred measure of the Bank of Canada, which is core inflation. Although it's been kind of sticky recently, if you look at more recent data from core inflation, we can see more recently it is pressures being taken off. So that's kind of the good news story. And we see going forward that core inflation will likely continue to trend downward because Canada removed retaliatory tariffs. We talked about the economic slack or the potential of the economy that exists. So we're seeing that both below the expectation. So growth's going to be slow this year. Growth's going to be slow next year. Bank of Canada is going to cut rates to 2%. And as well, when you layer on top of that, the labor market. So as you can see on the screen right now, wages are coming down. And so the wage growth right now is at the slowest level since 2020. And this is really something where a lower wage does get passed on to consumers in lower prices. So as those wages come down, which is a huge cost for business, that should provide some relief on the inflation front as well. And the one thing to note that's not shown here, but the job vacancy rate is at the highest level in 8 years. So JP, we see the really bad news on all fronts. Our economy is underperforming, inflation is coming down, and we're seeing a really weak labor market.
Yeah, and so you highlighted a little bit of the tensions right now in the economy, no doubt. And yesterday I was talking about the Bank of Canada cut. Like I understand, right? From a media standpoint, the one thing they'll discuss is what happens to the Bank of Canada rate, their decision to cut their policy rate. And that has a direct influence on short-term rates. So if you think of a variable rate, a loan that's priced under a variable rate, so the lower Bank of Canada rate feeds into a lower prime rate, feeds into a lower variable rate. But we tend not to discuss as much, I would say, the long-term interest rates, right? Because that matters if you think of a 5-year fixed rate for a mortgage. So what can you, like, if you look at a forecast, like what can you tell us about expectations with regards to long-term interest rates?
Yeah, sure. So I think step back, one thing we must note is how highly correlated Canada and US bond markets are. And so we need to not just focus on what's happening within Canada, but look at the US and see what's happening in their economy as well. And really what's happening in the US is a lot of the policies that are, the government's rolling out, such as the, tariffs, for example, their immigration crackdown, and as well as tax cuts. So, the big, beautiful budget bill is promising these tax cuts. So really what's happening is the bond market is saying, can US Congress really control the deficit? And so they don't think so. And so what's happening is there's building in a risk premium. So, if you can see the chart on the screen right now, as you mentioned, the Bank of Canada policy rate impacts those overnight rates, which is, like you said, is the variable rate lending. So any product that's variable rate, you're going to see those immediate cuts to that rate and should provide you some interest savings there. The one thing to note, if you look out towards more of the 5-year, and this is where it gets really, really interesting, is that since last December, that 5-year bond, which like you said, correlates and translates into a year fixed rate debt, has dropped about 25 basis points or so since last December. However, our forecast is for the remainder of the year, don't expect that rate to change very much. And so, if you're renewing your mortgage or if you're taking on any fixed rate debt, you can see that rate's going to be staying roughly where it is right now. So this is where, as a consumer, as a producer, as a business owner, you need to balance, what is your risk profile? If you have any debt you need to take on or refinance or renew, needing to balance between that short-term variable rate where, rates we know are dropping and that 5-year fixed, which we say is going to probably stay where it is today. So that's what we're seeing on the long-term rates.
Good insights in terms of where we stand with regards to inflation coming down, steadying, if I can say this, stabilizing to some extent, which would as well with the slow growth in the economy would lead to further cuts. Don't expect too much on the long term for the long-term rates. One last thing about the broad macroeconomic conditions, right? One of the variables that has a big impact on financial health of ag and food markets is the value of the Canadian dollar. Now, different businesses will have different perspectives. Some would wish a lower Canadian dollar because it allows us to be more competitive in foreign markets. Some perhaps might wish, to be for a stronger Canadian dollar because they have some equipment to import, but not. So what's the outlook for the Canadian dollar in the next little while here?
Yeah, so well, I'd say interest rates are a little bit easier to forecast what we know is going to happen over the next coming months. The dollar is a little harder to decipher. So if you think back to loonie, used to be called the petrol currency, very highly correlated with oil prices. And over the last number of years, that's been decoupled. And so now what we're seeing is that the dollar is driven by other factors. And what you can see on the screen now is actually how the loonie has benefited from a weakening of the US dollar. And this is really not much to do with Canada. It's more about that the US dollar is traditionally viewed as a safe haven. And with everything that's going on in the U.S. right now, with the trade wars, everything that I talked about, like with immigration policy, tax cuts, the dollar has weakened. The U.S. dollar has weakened, which actually has allowed the Canadian dollar to appreciate. But the one interesting thing to look at, the figure on the right, is the Canadian dollar actually hasn't appreciated as much as other currencies. And those currencies, even in developed countries and even developing countries. So the lack of appreciation of the Canadian dollar is really being driven by, like we've discussed, kind of those structural issues with the Canadian economy. We saw, like you said, exports in Q2 were down a lot, had a huge drag on our GDP. So we can see that as well. And the other thing is, if you look at Canada's current account deficit, and so this can be thought of as really the broadest indicator of Canada's trading and investing relationship with other nations. It's the worst rate it's been since 2020. So that's undoubtedly weighing on the currency. So, when we factor all of this in, what we're saying over the near to medium term, kind of, the next through this year and into 2026, is the loonie that'll be trading in a range of 72 to 74 cents. So JP, as you mentioned, while, a low dollar is not necessarily a good thing, but for our exporters it is. So you get that exchange rate premium. So that will, support the export market, hopefully navigating through, what we're experiencing with these trade wars.
Yeah, lots of different impacts, right? Higher Canadian dollar can actually raise costs, but also it kind of provides a boost to revenue. So in the aggregate, everything else being equal, I always say we're better off with a low Canadian dollar. But of course, you're going to find businesses that would prefer to have, an environment with a higher Canadian dollar simply because of the reality that they face. Okay, lots of good stuff there. So let's move to a kind of an overview of different ag markets. So we're going to start off with grains and oilseeds. Des, I'm going to ask you right away. If you look at grains and oilseeds, where would you start to look at some of the emerging trends to understand what the 25-26 marketing year is going to look like?
Yeah, well, I'm going to start with production because I would say, what we're seeing this year in estimates from Stats Canada is crop production is going to be slightly up this year compared to last, like up marginally. I think it's a good news story because if you look back over the last number of years, we've struggled with extreme weather, and so in 2021 and 2023 we had drought across the prairies. We've had wildfires. We've had excessive moisture in the east. That seems to, on that aggregate, seems to improve this year. We had weather that would allow for increased yields, that increased production. Not to discount that there were certain areas of the country that still did experience drought, still had some excess moisture. So, but overall, things did improve production-wise compared to last year. The one thing to note is that from last year, the actual carryout stocks were down 20% coming into this year. So you combine that with prices that have generally been pressured lower, that's going to impact revenues this year. And so that's maybe that we'll watch as well as how those prices unfold over the rest of this year, and how that's going to actually impact farm cash receipts. So that's on the production side in Canada. And we know very well that we also need to look at what's happening in other markets, other countries as well. So we're going to look at the US and south of the border, you can see on the chart on the screen, the US's corn production is going to be at a record level. So this is driven by record yields and increased acreage. It's the highest acreage it's been in over 90 years for corn. So it's a huge, huge corn crop. So with that huge, supplies, huge production, we're actually seeing an increase in the stock to use ratio. So demand isn't keeping up with the level of production that we're seeing in the corn market. And that's translating into lower prices. And you can see the chart on the left. The corn futures price has been trending lower. It's quite volatile, but you can see it's approaching the 5-year minimum as opposed to the 5-year max. So we know prices are on the lower end. We are coming off a commodity super cycle, so that's one thing to keep in mind is that with coming through the pandemic and Russia's war against Ukraine, we saw prices really climb. So we're seeing those moderation of prices. I want to point out something that was that I found very, very interesting because U.S. corn production this year is going to be about 427 million tons. So it's hard to wrap your head around how big is that? If you look at just the year-over-year increase, it's going to be about 50 million tons. That's the equivalent of the entire production of wheat and canola in Canada. So it just shows you how impactful, how large the U.S. ag sector is, and how their production can influence global prices. So that's on the corn side. We look at the U.S. and their soybeans as well. It's a very interesting story. What we see on the chart now on the screen is something very similar in that production has been increasing. And so over the last number of years, we've seen record production. It's grown very rapidly. And what this is being driven by is soybeans out of Brazil. So Brazil's been having massive crops of soybeans. So we're seeing that production increase, and demand hasn't been keeping up as well. So over that same time frame, we've seen an increase in the stocks to use ratio, which pressures prices lower. And very similar to what we saw with corn, soybean prices are trending closer to that 5-year minimum. So prices are being suppressed. The good news is when you look at this year, though, even though production is still up, we're also seeing demand increase. And this is something that's really interesting because what's happening is a change in the U.S. biofuel policy. And so they want to source more of their soybeans domestically. And so that's increasing the demand. So we're actually seeing that stocks to use ratio being pressured a little bit lower, which should provide some price support to soybeans. And that's good news for canola as well. That will shift over and hopefully help support canola prices. I do want to touch on China as well because it's really interesting right now with what's going on with China and the U.S. Because of the trade war, China is not doing business with the U.S. So China is actually sourcing their soybeans from Brazil. And I talked about Brazil having massive crops. And so they're sourcing from Brazil. They haven't bought any new soybean crop from the U.S. And because of the tariff. So Brazil soybeans are actually trading at a little bit of price premium to the US. But if you add the tariff on, China actually is more beneficial. It's more favorable from a cost standpoint to source the soybeans from Brazil. How that unfolds, time will tell. These trade wars have been dragging on for quite some time now. And so we're not sure what will happen in the future. But JP, I want to flip it back to you because speaking of China, I touched about the US, but really for Canada, the biggest impact on Canada is China's tariffs, mostly specifically on canola, meal, and seed. So how do you see that situation evolving?
Yeah, so there's no understating it, right? This is such a big deal. I mean, we've lived with the Chinese tariffs now on exports of meal, canola meal and oil for a while now. I mean, and certainly when it comes to China, a canola meal story more than an oil story, a bit different, or kind of the opposite when it comes to the US. 75% tariff on canola seeds is a big deal. And now we have a little bit of time for China to decide what they're going to do with it. I think the March 2026 now is kind of the deadline or the new deadline to kind of have a final determination of that tariff. We'll see how negotiations evolve between Canada and China when it comes to canola seeds. But we'll put up a chart up on the screen that kind of just displays the situation when it comes to the canola market, right? So the red dot is the forecast as a stock to use ratio and what we can expect in terms of prices for this marketing year. And you can see that, that stock to use ratio is moving up. Now, critical aspect is kind of how much can we expect, how much of a pull can we expect from the export market? I'm going to look at my notes here just not to mess up the numbers, but we're talking about 7 million tons of canola seeds exported now for this marketing year, as opposed to around 11.8 million tons crushed domestically. But if we were to see that 7 million ton actually come down a little bit, that's going to move the stock to use ratio to the right, and that should actually put downward pressure. So my entire argument with regards to canola is that there's quite a bit more downside risk than upside risk. You're talking about corn and soybeans. We're showing prices that are near the bottom of the 5-year average. Talking about canola prices being exposed to some downside risk. What I find interesting, and then we'll show you a different chart here that looks at the relative profitability of canola versus wheat, right? So and I know this is not the time to lock in some seeding plans, but if we were to have to make decisions today about 2026 seeding plans, despite all the downside risk associated with canola, you would still, for those businesses that have the ability at the margin to kind of just switch their seeding plans, you would still find it most profitable to plant canola. And so that speaks to what? That speaks to the weakness in the wheat market too. And so when you add those two together, you say, all right, quite a bit of downside risk. I mean, some pressures on profitability with canola, for sure. More downside risk just because of how this export situation is going to evolve with China. Yes, we can find ourselves exporting to other markets, whether it's the United Arab Emirates, for example, which happened, right? We saw our exports go up at that time in 2019, 2022, when we were facing some challenges with China. But the bottom line is downside risk in canola, weakness in the wheat market. So when you think of these prices and put them in a profitability context, that's not necessarily going to paint a super positive situation. So Des, before we get to profits, I'd just love to hear your thoughts about inputs. Maybe we just focus on time permitting one input, maybe fertilizer, and see what you're seeing there, and then we can just aggregate everything and then look at profitability maybe.
Yeah, thanks, JP. What we've seen is actually through the summers, fertilizer prices have been, rising, and this is usually a time when we see fertilizer prices that are, usually falling or stable. But this is, like I mentioned, really being driven by the large crop production out of the U.S., out of Brazil. We're seeing demand for fertilizer both in the U.S. and globally. So we're seeing demand, which is pressuring those prices. And then on the phosphate side, we're actually seeing shortage. So that's supporting the prices. And when you want to kind of assess how affordable is fertilizer, one of the metrics we look at, and you can see the figure on the screen here, is our fertilizer affordability index. So what this measures is like the price of fertilizer to the price for the crop that you would get. So a higher ratio means fertilizer is expensive relative to crop prices. This ratio can actually influence producers' input decisions when which crops to grow, and as how much fertilizer used, to maximize profitability. And so we've looked at our projections, so you can see 2025 where those ratios are at. If you look at our projections going into 2026, you can see that it's for corn and soybean, we're seeing an increase in that ratio, which means it's fertilizers becoming less affordable. And it's for canola wheat, it's stable, so but it's still a higher ratio than we would expect. And so this is going to be something that does impact margins, and that's what we're going to look at next. And so it's fair to say, with everything that's going on, there's a lot of uncertainty in the market. We're seeing pressure on still input prices that I would say are higher than historic. We're seeing that downward pressure on commodity prices. So if you take all this information and kind of aggregate it together, this is where we calculate our margins. So as you can see on the screen, we're showing margins here for both Eastern and Western Canada. And on the left is a canola wheat rotation. And it's pretty easy to see, we're coming off, last year was a pretty tough year. And then we're seeing for this year, our forecast is break even or slightly above break even. So, the margins are going to be tight and well below that 5-year average. And like I mentioned before, I know we're coming off a super cycle of commodity prices, but this just highlights, how tight the markets are right now, and how tight margins will be. In the East, things are a little bit better. Margins are a little more positive, but very similar trends. We're seeing, this year be a little bit higher than last year, but still below that 5-year average. So, if you step back, this is where, you talk about productivity, efficiency. This is where, an operation really needs to look at, is there anywhere I can save some money? Or, really keep an eye on what the markets are showing as far as yield potential and production. So if we see out of the U.S., corn yields are coming down because we've heard there's some disease that is actually starting to show in their corn crops, that could pressure yields a little bit lower, might provide some price support. So, JP, this is where we can see, an operation needs to really look and keep an eye on the markets to know where they can lock in a little bit extra revenue or find those efficiencies in cost. So I did talk about earlier about carryout stocks, prices, and what the impact would be on farm cash receipts. So do you have any insights on kind of what we can expect for farm cash receipts this year?
Yeah, so we're staring at another decline in receipts for grains and oilseeds in 2025. We had a 10.8 decline in 24, looking at a decline again around 6%. This is the forecast for 2025 calendar year. So 2026, better production. So we'll see where that goes, but there's still a bit of downside risk to prices. I think it's better on the livestock side. We're going to cover this in a second. Just want to go back to it. And we don't need to put the chart up on the screen again, but just to go back on, because we like to show or present profitability trends, right? And so the margins that Des put up on the screen, they're really just a informative or information to assess different trends, right? So there are tons of different assumptions that go beyond, in building these profit margins, profitability projections. And so the bottom line is the way to look at this, and we're going to show you some more projections for the livestock, for some livestock sectors. The way to look at this is, look at the trends. Don't necessarily look at the numbers, because when you look at grains and oilseeds, we actually computed this before land costs. So depending on whether you're renting land or whether you have an ownership model, it just that profitability is going to evolve or is going to look different. And depending on where you are in the country as well, land costs will be different. But it's really the trends that matters. So I think the relevant thing to do here when we show you profitability trends is to actually take a step back, look at the trend and say, oh, is it going up or down relative to where I'm at today? And if it's going up and down, based on what you see up on the screen, then it should be going up and down as well for your own operation. And then it's just, what do you do about it, right? What do you control, to your point about productivity? So let's go to the livestock sector. I'm going to kick it off with hogs. It's been a good 2025 so far, let's just say. We have had a challenging 2023 when it comes to the hog sector. We've had a better 2024, and certainly at the end of the 2024, there was lots of positive things in the market. But if you look at the numbers right now, and I'm looking at my notes just to make sure I'm not, again, getting the right numbers, but we have, inventory of hogs in Canada down about 1% year over year. So the most recent numbers look back 12 months. We're about 1% below on the inventory front. And this is not surprising just because of what I was telling you about in terms of market conditions, but things have been improving. In the US, because again, we're quite dependent on pricing from what is going on with the supply and with the balance between supply and demand on the US side. In the US, inventories are up actually. Now, the good thing for us is despite our inventories down, and we've been making major significant productivity gains when it comes to the hog sector. If you look at pigs per litter, for example, we are around 14 now. It's a significant progress, significant upgrade in terms of productivity, in terms of where we were just a couple of years ago. Same thing has happened in the US. Numbers, inventories are up, and yet the futures markets don't necessarily seem to be phased by these higher supply numbers. So I think that's a good sign. So if you think of what the futures markets are telling us when it comes to hog prices or anticipated hog prices, if you take what we've been talking about in terms of grain prices, for example, are expected to stay where they are, maybe a little bit of downside risk, I would argue, because of all the trade tensions. If you put everything together, we're going to put on the screen some profitability projections for two different regions in Canada, farrow fish operations in Manitoba and Ontario. And again, don't pay attention to the numbers, but just to really look at where those blue bars are, where that five-year average is relative to what the forecast is. And of course, it's showing that 2025 is shaping up to be a positive year. But we're, in some cases, coming off really challenging conditions, right? Feed costs are different in different regions, so but that explains to some extent some of the differences in profitability. Pricing is a bit different as well. But the bottom line is that we have an optimistic 2025, 2026, less optimistic than currently is. But nonetheless, I think there's positive or profitability on the horizon based on what the futures markets are telling us. What I find in this exercise is that demand matters a great deal, right? And when it comes to trade, if you look at China, again, kind of taxing pork exports out of Canada at a rate of 25%. If you look at the first 7 months of the year, which is the data that we have right now, we're not seeing much of a change in our exports going to China. China used to say, well, the third market, third most important market for pork exports in Canada. I think it's now more than number 5 than number 3. Bottom line is the volume of our exports have actually come up a little bit to China, come down in value though. But if you focus on the last couple of months, our exports to China have been significantly down compared to what they were a year ago. So that more than like 20% decline in our exports to China year over year. So it's definitely an area to monitor because we need that market to offset some of the revenue pressures, perhaps in the pork market. So the second thing is, though, there are some export destinations that are doing super well. I mean, Japan, South Korea, both are showing year over year for the first 7 months of the year, more than 25% growth. So that's extremely positive when you look at it from a national standpoint and saying, hey, there's an export demand for us. In the US, they're shut down the border to Mexican hogs. Sorry, I'm thinking of cattle now, so we'll wait for cattle in this case. But the U.S. side doesn't seem to be phased by kind of the high supply numbers. And the fact of the matter is that consumer demand is still relatively strong, given that retail prices are not as high for pork than they are for competing proteins. And so that brings me to cattle, and I'll leave it up to you, Des, to kind of give us an overview of what we can expect in the cattle market for 2025 and part of 2026.
Yeah, thanks, JP. Yeah, it's interesting because beef prices, I know it's top of mind for a lot of people, and food inflation, especially grocery stores, is higher than overall inflation. So it is still a concern, overall grocery prices, and beef is no exception there. So similar to what we're seeing in hogs, inventory matters. And so, when we look at the cattle inventory, it's actually increased this year. And so it was up about 1%. It doesn't sound like much, but just to highlight, this is actually the first increase we've seen since 2021. And so, we've seen since 2005, a declining herd, which is, resulting in inflationary pressures on beef prices. So we look for any glimmer of hope. And I think this is one of them where we see that inventory trending a little bit higher. And what's driving this is actually fewer cows and heifers being sent to slaughter. And so when those heifers are being retained, and we're seeing that up to about 2%, so a little, still a pretty small number, but it's still that glimmer of hope. We're seeing heifers being retained, and that's something that will contribute to expansion of the herd in the future. It does take time. We know the beef herd does take time. Cattle herd takes time to rebuild. So that's going to take some time, but it is some optimism there that we're going to see the herd starting to be rebuilt in Canada. And when I talked about the number of cows and heifers being sent to slaughter, In the first half of the year, it was sitting at, let me get my number here, 44.6%, which is a decade low. So we're actually seeing maybe this is that turning point. We're finally going to start to see the cattle herd being rebuilt in Canada. So there's optimism, but we also have to look what's happening in North America, and you touched on as well. Like the U.S. matters, and so if we look at the U.S., they've faced some very similar herd reductions in Canada. I think their herd right now is at a 60-year low. And so we need to also look at what's happening there. And so the chart on the screen that you'll see now is an aggregate of North America, the number of cows and heifers being sent to slaughter. So I talked about Canada, we were at 44.6%. When you look at the North American market, it's between 48 and 49%. So it's still above where it is in Canada. And we kind of have a magic number, and it's 47%. And so if less than 47% of cows and heifers are being sent to slaughter, that's a good indication that we're going to see the herd being rebuilt in North America. We're not seeing that yet. And so this is going to contribute to, either a flat or maybe still declining North American herd. So the bad news is, JP, don't expect those retail prices of beef to come down anytime soon until we actually start to see a more material herd rebuilding. So in Canada and the US. So, when you look at it from an aggregate standpoint, we talked about feed costs. As you mentioned, with lower crop prices, that actually benefits the livestock sector because feed is now, feed costs are coming down. It's more efficient for feeding. And so I'm going to show the margins for cow, calf, and feedlot on the screen right away here. And what's interesting, and a good call out on, not getting hooked on the numbers on the axis, but just the levels. What we can clearly see is, cow, calf on the left, very strong margins. We've seen really strong margins over the last number of years, well above the 5-year average. And we expect that going forward into 2026 as well. For feedlots, we're seeing that as well, improving margins, trending higher. And, one of the things to note as well is that why the cow-calf margins are dipping a little bit while the feedlot are improving is the difference between the fed cattle price and the feeder. And so we're actually seeing that there is a little bit more spread there. When we see that spread, it actually helps to benefit feedlots and their margins there. So, we talked a lot about, on the revenue side, we talked about feed costs as well. This ties nicely into dairy. So, JP, what are you seeing on what's happening in dairy? Is there anything that stands out for you?
Yeah, so good question. I'm gonna start with consumption trends. I think that's part of the story. You got some segments. If you think of yogurt, ice cream, over 8% growth over the last 12 months. So I think that's a positive. And because of this, and some other segments as well showing no growth, but the bottom line is I think that's a positive. And as a result, we're going to put a chart up on the screen that looks at, where milk is being allocated across the different classes. And you see, right, that milk being diverted. I got the P5 example here, being diverted up to class 2 and class 3. Obviously, the mix of where milk goes and those components of milk matters in terms of pricing. But the bottom line is, I do think that there is a positive trend when it comes to consumption. So I think it's hard to argue that, or can't to argue too much that, dairy proteins are competitive with regards to the entire, availability of options that consumers have. The bottom line is, I do think that milk is shifting a little bit. So I'm gonna have to continue to monitor this. In terms of production, I think we have, the milk pool, for example, in the West has seen quota growth of 2%. Yes, they've taken 3 days out, I believe, of incentive days for production. But the bottom line is that they're still, looking at big picture, more than 15 days of production that have been allocated. So I think that there's good growth there. P5 got 3 additional production days or incentive days as well in terms of production. So overall, I think there's strength in demand. And that's even with considering, and this is an important thing, considering that population growth has not or stabilized to some extent, right? So if you look at, we got numbers for the first quarter of this year. We don't yet have the numbers for the second quarter. We're almost at the end of the third quarter, but the first quarter numbers when it comes to population show that actually we can expect that population growth to stabilize, right? So we're still showing year over year an increase, but quarter to quarter, definitely seeing Canadian population kind of stabilizing. So that boost because of more people is not going to be there in 2025. So to see the current trends that we're seeing, I think is somewhat positive. Now, of course, from a revenue standpoint, production is one thing, revenues is another thing, so price is another thing. So when it comes to the milk price, we have that, the Canadian Dairy Commission is computing what the target milk price should be, and that's based off an index of cost of production as well as a consumer price index. So the consumer price index 1.9%, just below 2% when it comes to dairy. So that's one thing that we have to think about is that that dairy milk price is going to be influenced by that consumer price index around 2%. But if production costs remain stable around zero growth, then that could actually result in a 1% change in the milk price effective in 2026. So that's currently the forecast. Obviously, more to come and more information is going to be coming the way. And then the last thing that I think matters as well is to monitor what's going on with stocks, butter stocks. So a little bit of a shift there. Stats Canada actually reports now on a quarterly basis as opposed to on a monthly basis. But if you look at the data reported by the Canadian Dairy Commission, we have inventories of butter right now that are a little bit higher than normally what they would be, even accounting for the fact that there's been lots of population growth in Canada over the last couple of years and certainly in 2024. So that's something to monitor. If that inventory is not coming down, more in line with what historically the average has been, then maybe that's going to probably cap production. But overall, I think I'm fairly confident on the consumption trends. And it's just a matter of if cost remains constant, I think there's good profitability on the horizon for the end of 2025 and into 2026 for dairy producers. So I was just talking about stocks, Des. I mean, I know stocks matter a great deal as well if you think of the broiler industry. So what is it that you monitor in that particular market?
Yeah, so the stocks do matter, and whether it's livestock or crops, we talk a lot about stocks, and so it's no different in the broiler sector. But the one thing I want to do is look back to last year in 2024, and there was a bit of a transition for the industry in that year, and the reason why is because Chile joined the Trans-Pacific Partnership in 2023. And so with Chile joining, we actually saw a 20-fold increase in chicken imports from Chile, which it sounds like a huge amount, and it is. We also need to keep in mind that total imports, account for between 1 to 1.5% of total domestic production, but we don't want to underestimate the financial impacts that can have. So that's kind of where the market was transitioning from 2024. And so as well over the last couple of years, production has ramped up. And as you can see on the screen, the figure shows last year, production levels, stocks per capita were nearly an all-time high. And so we can see there was, increased imports, we saw increased production, and at the same time, processor demand was lower. So, we saw those stocks really high. And what had to happen for stocks to get back within that kind of more historical range that we would expect is that production had to decline or slow. And so we actually did see that in the second half of last year. Broiler production was flat. And so to put this into perspective, that was the lowest growth in 15 years when you exclude COVID. COVID kind of, distorts a lot of the numbers, but if you look past COVID, the lowest growth in 15 years. So it's something to be really, really mindful of. And as we head into this year, you can see that those stocks now are, more in line with historical, actually probably a little bit lower. So we're actually seeing a bit more balance in the market now for broilers. And as well, we're expecting that total imports will be met under those trade agreements. So Chile's going to fill a lot of the imports that come into Canada. But because demand has also started to pick up, we're seeing quota production increases in the second half of the year, which should allow for increased production as well. So we're going to get more balanced on the supply side, more balanced with demand as well. And so combine that with what we've talked about is easing feed costs. That's going to support margins this year. So it's been a bit of a transition over the last couple of years in the broiler sector, but we are starting to see more balance in that.
Yeah. And just hearing you, Des, talk about trade, I mean, one of the things that we could add, going back to dairy is that there's obviously a lot of things to monitor there as well when it comes to trade, right? We got CUSMA review. I was going to say renegotiations. It starts off with a review scheduled for 2026. The U.S. has already kicked off their public consultations with regards to CUSMA. It just opened it up. So for U.S. businesses to submit their comments, observations, recommendations, whatnot. So that's going to be something that will come up in 2026. Looking to have a busy 2026. The USITC has launched an investigation into dumping of proteins coming out of Canada, which is, to me, doesn't make any much sense, frankly, because I mean our market share when it comes to global exports is very, very, very little compared to what the U.S. market share is. Got some good news though on when it comes to New Zealand. If you look at the resolve of the disagreement between the allocation of those import licenses under the tariff rate quotas, I'm not expecting a major shift. I mean, yes, you could see a little bit more imports coming from New Zealand for some specific products, but if you look at butter, for example, that fill rate for butter was already up there at 90-some%. So not expecting a huge shift. So there's some good news, but there's also a lot of different things to monitor on the trade front that are going to come back before the end of the year. I suspect it's going to be a busy fall when it comes to trade negotiations and trade issues, as well as, into 2026. Okay, let's use the time that we have to focus on food processing. There's a lot to say there. The food processing sector, we like to package it in one sector, food and beverage manufacturing, but at the end of the day, the reality, it's a very diverse sector, Des. So how can we just kind of get a grasp of trends to monitor in 2025, potentially as well, kind of a sneak peek of what to expect in 2026?
Yeah, there's a lot of sectors within food and beverage processing, but we just don't have the time today to get into it. But I do want to put a plug in for, our food and beverage mid-year report is coming out next week. So we'll have a lot more details. So I encourage people to go to the website and check out the report. I would say that, that overall the sector has shown a resilience this year and amid all the economic uncertainty. So, as you can see on the screen, the chart shows sales are tracking still positive this year. So very small increase, 0.2%. This is far less than we had forecast in January before, kind of everything happened with tariffs and the uncertainty and, any the trade disruptions, but it's still positive. So I think that's the good news story out of this, that sales are positive and we're looking to see them rebound next year. So that we'll see an increase. On the flip side, the one thing to note as well is volumes are decreasing. They have been decreasing for 3 years. And this means, people are buying less. And this is not surprising because we know that the consumer is under pressure, financial pressure, high debt loads, interest rates that have, are coming down and will come down even further, especially variable rate. But, debt servicing is something that's impacting consumers' purchasing. So that's impacting the slowdown in volume, over the last number of years. And as well, you highlighted earlier, JP, we didn't dig into it a whole bunch, the population growth. And I think that's something to really call out is we've seen really strong population growth that has really, I think, helped support the Canadian economy. We're not seeing that as much this year with slowing immigration and that population growth slowing. So that's going to weigh on the sector as well. But still some optimism heading into next year. And so, I think when we look at it, we're not going to get into the subsectors. We just don't have the time. But I do want to ask you, JP, are there any, sectors that you want to just call out that maybe are faring better or worse than others?
Yeah, I think so first off, I'm going to reemphasize or mention again the September 24th report, because this is where, if you think of the previous slide, no need to bring it back up on the screen, but if you think of the previous slide illustrating sales in dollars or sales, kind of an index of sales, but in volume, so stripping out the effect of inflation, I think that's super relevant for the different sectors. And different sectors, to your point, will experience different trends, right? So if you think, and I would say that some of the declines we've seen up to 2024 have been mostly driven by internal factors, internal to Canada. So pressure on consumers you were talking about, but now we're starting to see that trade matters a little bit. So the trade exposure of a sector, if you think of grain and oilseed milling, for example, as a processing sector, quite exposed to what's going on in the United States. If you think of dairy, well, less so obviously, just because of the way that the market's structured. And then we've seen some growth there, and we're anticipating that there'll be more growth coming in as well. So really, when it comes to how diverse sectors fare, I think we need to be looking at exactly what's going on in terms of the exposure to the U.S. market. As I said, it's not just a matter of being compliant with CUSMA. There are different implications of having exposure to the U.S. market, and I do think that this is something to monitor. Now, the Buy Canadian uh, movement, if I can say this, is definitely significant, Des, I'd be curious to hear your thoughts on like what do you see from a domestic consumption standpoint. I think you can say almost that some of the trade tensions discussions have kind of provided a little bit of a free buy Canadian type of publicity, a marketing campaign around Canadian products, which is a good thing. What do we see there, and how do we see this evolve, perhaps?
Yeah, so I think there's a couple things we want to highlight. Is first off is that consumer spending on food and non-alcoholic beverages rose a little bit in Q2 on a per capita basis. So that's a good news story. So we're seeing that reversing trend, which we should see continue into next year, where those volumes will increase. And as well, the Buy Canadian, whatever you want to say, that patriotic action that consumers are taking has an impact. And so we actually see about 20 to 25% of manufactured goods coming from imports. So what happens domestically is a huge impact on that sector. So, the more money that Canadians spend within the borders on Canadian goods, the more benefit it'll have for the sector as well. And as well, the one thing I want to highlight is, we talk about trade diversification, and it does take time and it is challenging. But as you can see on the screen, when you look at year over year, we're actually seeing a shift. It's small, but it's happening, and we're seeing that shift away from the U.S. So this is comparing Q2 of 2025 to the previous year. And so this is a good news story. This is where we are actually seeing some of those inroads made into other countries. So we're not as dependent on the U.S. So when these, whether it's the current tariffs or like you mentioned, CUSMA review coming up, this is where we need to make sure that we, as a nation, really support our industry and look at those opportunities, else outside of the U.S. for our exports. So, Buy Canadian is something that has helped the sector. Is that going to continue on? I hope so. I talked about the consumer and how indebted they are, but they still need to eat, and so I think that's a matter of where they choose to buy, what the source of the product is coming from. So we talked about the sales, we talked about volume. So JP, if you're kind of wrap it up, what are you seeing overall for margins in the food and beverage sector?
Yeah, good point. We talked about sales, talked about a number of different things. So when you kind of add it all up together, right, in terms of profitability, the one thing that I'm struck every time I look at this is that when it comes to margins for food processors overall, and of course we mentioned the diversity of different sectors, but when it comes to margins of food, the food processing or food and beverage manufacturing sector, we're still not back to where we were in terms of gross margin relative to sales to where we were in 2019, so pre-COVID. We'd had tremendous pressures to begin with because of higher costs. Those costs have come down. I mean, we did mention at the beginning of the presentation the labor market, right? I mean, that job vacancy ratio is going to lead to lower pressure on wages. Now, there's a flip side to all of this, which is, well, it's not great for the consumer, but for businesses, it is absolutely a good thing, right? That you should see more the pool of available workers grow over time. It's currently about twice the size that it was at the height of COVID, where job vacancy ratio was really, really, really tight. So bottom line is that pool is growing, maybe not necessarily good news for the state of the economy, but from a business standpoint, that should lower finally, I would say, because it's taken forever to see wage pressures come down. And now we're starting to see it. So hoping that from a business standpoint, we see a continuation of those lower margin pressures, lower wage pressures, because then that means that margins are going to be able to regain a little bit. And I was for this exercise today, I was looking at what our projection was at the beginning of the year for 2025's margins in the food and beverage manufacturing sector, and our projections were more optimistic than really the first 7 or 8 months of the year for which we have data. So it's going to take until 2026. Again, I think those costs are not moving down fast enough, if I can say this. And that creates a bit of pressure on margins. But I think we're seeing light at the end of the tunnel when it comes to margins. And I think that's a good news. And again, like the picture is so different. Invite you to go to our website next week. I think you'll have a lot of the different numbers and data points to look at different sectors or the specific sector you're in. So there's, maybe you and I kind of conclude with a couple of questions. There's the two questions that I see. We got 5 minutes, so we'll try to wrap it up real quick. One of which I can address with regards to interprovincial trade barriers, because that's one of the things that I feel like we have control over, right? And then if you think we've made there's been a lot of debate around the need for us to diversify away from the US. And then we're going to release a report pretty soon, our thought leadership team, that will look at the possibilities across different sectors of our economy and food to actually diversify away from the US. The US is always going to remain a major import market for us, or a major export market for us, I should say. It's the largest economy in the world. It's located next door. Obvious benefits to being able to sell in the US market. At the same time, from a risk management standpoint, it opens up opportunities for us to diversify away. And then when you think of diversify away from the US, maybe one strategy would be looking at interprovincial trade, right? If we're able to trade more east-west, that can actually displace some of the exports that the US is sending in to this side of the border. And so displacing US exports, more interprovincial trade, and I'm not talking obviously BC to Atlantic provinces, and I'm talking more like Atlantic provinces together, or more Quebec, Ontario, Prairie provinces, like where we can actually eliminate some of the redundancy of standards across provinces, modernize regulations, invest in infrastructure, all of these things, kind of that productivity mindset that we talked at the very beginning, all of these things can actually lead us to more interprovincial trade. So definitely a potential benefit. It's going to be hard. It's not going to happen by itself. If it'd be easy, it would have happened a long time ago. But I do think that as we're talking about diversifying away from the United States because of tariffs, and I think that's an avenue that, to me, makes a lot of sense. Now, the other question, and we won't have time for more, but another question is about those tariffs, right? What can we expect? Like, Des, if you think of how permanent this trade landscape being redefined is going to be, what can we say about this? Like, are we likely to see tariffs go away in a few months, or are we likely to see tariffs be implemented for a long period of time, right? So what's our assessment of all this?
Well, I'll get out my crystal ball because I think that's going to be the challenge. But when you look at what the US has done so far and how they've positioned tariffs, and they're looking at it as a revenue generating solution to their deficit. And so I think that what's going to happen is they're going to become reliant on tariff revenue to help support and try to reduce some of the deficits they run each year. So I would say, you look at some of the more recent trade agreements that they've signed, Europe was like 15%, some other countries were, in the same ballpark. I think that's going to be the norm with this administration going forward, is they will have some level of tariffs. So, you mentioned CUSMA. It's going to be really, really interesting, the review process, because I wouldn't be surprised if the U.S. pushed to have some things renegotiated underneath within CUSMA. So we'll see how it unfolds, but I would say that I would expect tariffs to be in place for the foreseeable future, especially under the current administration, as they make comments of how much revenue they're generating each month because of the tariffs they're collecting.
Yeah, that's a good point. That reminds me of a citation. Unfortunately, I can't recall who said this, but it's something about like there's no such thing as a transitory tax, meaning that once you get kind of the benefit in terms of revenues of the tax, in tariffs in this case, and I think the U.S. is on track for a lot of dollars. And I can't recall the exact figure on top of my head. It's hard to actually wean yourself off the tariff revenue. So it definitely feels like the trade landscape is evolving to some future permanent state that's hard to anticipate what that's going to look like, but something for sure to monitor. Hey, You can count on us for an update, a regular update as things evolve. That's the end of our program today. And I encourage you to go for more information. Go to our website at fcc.ca/economics. And as usual, always a pleasure to hear your comments. You can always reach us to a question or an email on the website itself. So thanks for joining.